In less than 48 hours, a market that's supposed to move in slow, heavy steps dropped like it hit a trap door. 8% on the day after being down close to 10% intraday. 64 the week before, a drawdown of roughly 37%. It's an event, and here's the part that breaks normal expectations. While this was happening, one of the most watched equity benchmarks in Europe, the FTSE 100, was closing at a record around 10,941. In other words, risk was smiling, while the classic safety trade was on fire. They said this could never happen in a clean way, not like this, not with moves that look more like an emerging market currency than a centuries-old store of value. The timing matters, not months, not weeks. In 48 hours, the market went from celebrating fresh highs to demanding cash like a landlord with a key. And the reason is not a secret if you know where to look. Institutions already know because they watch the plumbing, not the headlines. Most people watch the price and assume price is the story, but price is often the symptom. What I'm about to lay out isn't a conspiracy story. It's the mechanics of collateral, leverage, and policy colliding in real time. There's a specific move that confirms the system is cornered, and it's not a tweet or rumor or feeling. It's an action taken by the venue that sits at the center of the paper metals universe. When that venue changes the rules, you don't get a debate. You get forced behavior. And forced behavior is where the biggest dislocations are born. Welcome to Signal and Structure. This channel is where we translate market plumbing into plain language before it's packaged into a headline. If you like the feeling of understanding what's happening, while everyone else is still arguing about what it means, you're in the right place. Consider subscribing the way you'd keep a wise elder's number saved in your phone. And tell me in the comments where you're watching from, because these moves don't hit every region the same way. So what actually happened? The spark was a violent reassessment of the path of U.S. monetary leadership, with markets reacting to news that Kevin Warsh had been nominated to succeed Jerome Powell in May. That headline didn't just move sentiment, it changed the expected trajectory of rates, the dollar, and the speed at which leverage can survive. In normal times, gold might dip, traders might debate, and the market would find a level. But these weren't normal times because positioning had become crowded across multiple products that lean on the same collateral pool. To understand why the move was abnormal, compare it to typical behavior. Gold can swing 1%, even 2%, without anyone calling it a crisis. It can drop $30 or $40 in a day and still be inside the boundaries traders consider routine. 82 record in a matter of days is the kind of motion that forces participants to stop thinking in narratives and start thinking in liquidity. 81 in a week is not merely volatility, it is a violent repricing of what leverage can survive. That's where the central mystery appears. If the safe haven story was simply reversing, why were stocks calm enough to set records? Why did an index like the FTSE 100 feel comfortable printing around 10,341 at the same moment metals were behaving like the floor had vanished? The market was sending two messages. Those messages are not the same. Confidence can exist on paper. Funding is a physical constraint. When funding tightens, the price of everything becomes negotiable. Then came the move that confirms it. CME Group, which runs the COMEX futures market, raised margin requirements on gold and silver futures right after the crash accelerated. 8% for heightened risk, 5% for heightened risk. Those numbers sound like paperwork, but they are a direct bill delivered to anyone holding leveraged positions. If you're long, you need more cash. If you're short, you need more cash. If you can't produce it, the position is reduced for you. It wasn't purely a shift in belief about inflation, geopolitics, or central bank demand. It was a shift in requirements. That question is binary, yes or no. And when the answer becomes no across a crowded trade, prices fall until the remaining holders are the ones who can pay. This is the part no one is discussing when they post charts and argue about levels. Levels don't matter when collateral is the constraint. Now zoom out, because this playbook has a history, and the history is uncomfortably consistent. In 2011, silver went through a mania that felt unstoppable. It was the classic late cycle feeling, stories everywhere, leverage everywhere, and the belief that price only goes one way. Then, over 9 days, CME raised margins 5 times. The result wasn't a gentle cool down, the result was an unwind, and silver dropped by around 30% in a short window as leverage was squeezed out. The important lesson is that margin hikes don't need to predict the top. They simply accelerate whatever instability already exists. Go back further. In 1980, silver became the arena for one of the most famous squeezes in modern commodity history. The Hunt brothers' accumulation attempt ended with rule changes and increased margin requirements that forced a cascade of selling. Again, notice the theme. The turning point wasn't an argument on television, it was the rules of financing changing. In 1998, during the long-term capital management crisis, highly sophisticated portfolios were forced to unwind because funding and risk limits changed faster than positions could be adjusted. In 2008, when the global funding system froze, assets that were good were sold anyway because the problem was cash, not conviction. In 2020, the dash for dollars created selling pressure across markets that didn't deserve it on fundamentals, because the only thing that mattered for a few days was liquidity. That history is why the 2026 episode matters beyond a single chart. 81, you're seeing a funding system attempt to rebalance itself. You're also seeing how quickly sentiment can become irrelevant when clearing mechanics take control. This is not opinion, this is pattern. Now, let's talk about the players, because markets are not abstract. They are venues, institutions, balance sheets, and rulebooks. Start with CME Group. CME is not a bank, but it sits in the middle like one. It sets margin, it clears trades, and it protects the clearinghouse by demanding collateral from clearing members. When CME lifts gold margin from 6% to 8%, it is telling every participant, your position is now riskier in our model, and you will fund that risk with more cash. When it lifts silver margin from 11% to 15%, it is doing the same thing with sharper force because silver's volatility profile demands it. Then there are the clearing members and brokers. They are the pipes through which margin calls travel. The exchange sets a minimum, but brokers often add their own house margin, especially in stressed conditions, because they are managing their own exposure to clients. That means the effective increase can be bigger than the exchange announcement alone. A trader might see the public change from 6% to 8%, but their broker could demand more than 8% depending on internal risk controls. The result is the same. More collateral required, immediately against the same position. Next are the funds. Not all funds are equal. Some run low leverage and can sit through a storm. Others run structured strategies that rely on predictable volatility. Some are market makers who hedge continuously. Others are directional speculators who use futures precisely because margin allows them to control large exposure with smaller collateral. When margins rise by 1/3 for gold and by more than 1/3 for silver, the strategies most sensitive to collateral have to react immediately. Now layer in the banks and their research. This is where the optics get confusing. When a bank like JP Morgan can reiterate a 6,300 target for end 2026, it can sound absurd to anyone watching a collapse. But it's not absurd if you separate time horizons. A long-term thesis can be compatible with short-term forced liquidation. In fact, banks often expect forced liquidation events because they've seen them across decades. The contradiction is only visible if you assume every statement is about the next few days. Add the macro layer. The market reaction to a potential change in Fed leadership matters because it shifts expectations for interest rates and the dollar. When the expected path of policy changes, it affects the cost of carrying positions, the availability of credit, and the appetite for leverage. A stronger dollar and higher real yields tend to pressure precious metals in conventional frameworks. But conventional frameworks don't explain a 48-hour cascade. Funding does. Funding is the bridge between macro narratives and micro liquidation. And don't ignore the international transmission, precious metals. Markets are global. Futures set price references, but physical flows, refinery activity, and regional premiums can behave differently. When paper markets unwind violently, it can create temporary gaps between derivatives pricing and physical market signals. Sometimes that shows up as unusual spreads, unusual leasing behavior, or sudden changes in dealer posture. Those signals don't always make headlines, but they are the texture of dislocation. The price can be falling on screens while the real-world supply chain is simply adjusting to the shock. You had two markets telling opposite stories. One market, precious metals, was screaming that something broke. The other market, equities, was acting like the system was stable enough to celebrate, with the FTSE 100 closing around 10,241. That contrast is not a curiosity. It's a warning that different parts of the system are being priced under different assumptions. Here's one way to think about it. Equity indices are dominated by large, liquid companies, and they often reflect expectations about growth, earnings, and liquidity conditions at the index level. Precious metals, futures, especially in moments of stress, reflect the state of collateral, the pressure of leverage, and the immediate need to meet margin. So equities can look calm while the collateral-sensitive corners convulse. But the calm is conditional. If collateral stress spreads, equities eventually feel it, even if the first shock appeared somewhere else. This is where the paper versus funding split shows up. Physical markets adjust more slowly because bars have to move, inventories have to be financed, and dealers have to manage risk. The answer is that in a margin event, gold is not being judged as a haven. It is being judged as a position that either can or cannot be funded. Quantify the gap inside the margin changes themselves. 3% increase in required collateral, 4% increase. If someone was running a strategy with tight cash management, those increases force decisions. And decisions under time pressure create discounts. In stressed markets, discounts show up as abrupt price moves, widened spreads, and a rush to cut risk. Now, the evidence. Start with the tape. 8% that day after being down nearly 10% earlier. The speed is the clue. 64, 83, 368. That is not a gentle correction. That is a liquidation profile. Then the policy evidence. CME's margin hike, 8%, 5%. Those are the knobs the exchange turns when volatility threatens clearinghouse stability. The fact that they were turned right as prices were collapsing tells you the clearing apparatus was responding to stress, and that response would, by design, force some participants out. Now let's make the mechanism simple. Futures markets are built on leverage. Leverage is not inherently bad. It's a tool, but leverage is a promise that you can post collateral today and settle tomorrow even if prices move. Margin is the safety buffer that makes that promise credible. When volatility rises, the buffer must rise too, because the probability of a loss between settlement cycles increases. Raising margin is the exchange's way of ensuring the system doesn't fail at the clearing level. Use an analogy. Imagine a bridge that has weight limits. On a normal day, trucks cross and the bridge holds. If an earthquake hits and the bridge is wobbling, the engineers reduce the allowed weight. They don't do it because they hate trucks. They do it because the bridge is under stress. Futures margin is that reduced weight limit. When CME increases margin, it is effectively lowering the amount of leverage allowed per dollar of collateral. Participants must either bring more collateral or reduce the load. And selling in a stressed environment is not clean. It's not a classroom exercise. It's a stampede through a narrow door. When many participants try to de-risk at once, bids get thinner and price gaps appear. That feeds back into volatility. Higher volatility leads to more risk calculations, more margin pressure, and more selling. The loop continues until the system finds a set of holders who can fund the positions at the new margin level. This is why the move confirms the corner. It's not about someone's opinion. It's about the system admitting that volatility has reached a level where the old collateral requirements are not sufficient. When the exchange tightens, it is choosing stability over price. It is saying, in effect, the clearinghouse must be protected even if it means a violent repricing. And once stability becomes the priority, price becomes the release valve. And notice how quietly this happens. A margin bulletin is not designed to go viral. It lands on a risk desk, inside a broker portal, and inside clearing reports that most people never read. Yet it can move more metal faster than a week of headlines. When the margin rate changes, the effect is mathematical. The same position now consumes more collateral, which reduces the amount of risk a portfolio can carry. Portfolios don't have infinite cash. They have limits, credit lines, and settlement calendars, and those constraints turn intent into action very quickly. That is why safe assets can be sold in a panic. Futures positions are marked to market daily, and variation margin can drain cash even before initial margin rises. If price moves against a position, cash leaves the account immediately. If the exchange then raises requirements, even more cash is needed immediately. That double hit turns a normal drawdown into a scramble. It also helps explain why equity indices can look calm at the worst moment. Index levels can be supported by a small set of very large companies, by passive flows that don't react instantly, or by the simple fact that the most levered players are being squeezed somewhere else first. But the plumbing connects these arenas. When collateral is scarce, correlations tend to rise, and markets that looked independent start moving together. Historically, the turning point becomes visible when forced selling stops being contained inside one corner of the market. That's why the best tell is not a single red candle. It's whether the system keeps demanding more collateral after the first shock. If margin requirements rise again, if daily ranges stay extreme, and if cross-asset funding conditions tighten, the stress is still active. If those pressures ease, the market can normalize faster than most expect. So what does this mean next? Historically, when this pattern appears, the aftermath tends to follow a recognizable sequence. The conservative scenario is a washout and rebuild. Forced selling ends, volatility cools, and price starts to behave normally again. The moderate scenario is a two-step unwind. The first liquidation reveals hidden leverage elsewhere, leading to further cross-asset stress and a longer period of unstable trading. The aggressive scenario is systemic spillover, where collateral stress leaks into multiple asset classes and forces broader deleveraging. No one can know which scenario dominates in advance, but the indicators are measurable. Watch for additional margin changes. In 2011, it wasn't one hike, it was a series. If further adjustments occur quickly, it signals that volatility is not calming. Watch whether daily ranges compress or remain extreme. Watch the relationship between equities and collateral-sensitive assets. If equities stay euphoric while collateral stress persists, the probability of a delayed catch-up rises, because the plumbing tends to reconcile contradictions. Also, watch the narrative war between short-term tape and long-term thesis. When institutions keep talking about structural outcomes like 6,300 gold by end 2026, while the market is still digesting a margin shock, it means the long-term demand story may still exist, but the short-term funding story is dominant. The market can punish both believers and skeptics in the short run if they are underfunded. Funding is the gatekeeper. Now we get to the divide. The split isn't between optimists and pessimists. It's between those who understand market structure and those who only react to price. People who only watch price experience moves like this as chaos. People who watch the plumbing see the sequence. Policy shock changes expectations, volatility spikes, margin rises, collateral is demanded, forced selling accelerates, and dislocations appear across assets. It's not about being smart, it's about watching the right variables. In markets that run on leverage, information about mechanics becomes power. Institutions move first because they monitor funding, risk models, and clearing constraints in real time. By the time a headline says gold crashes, the forced selling has often already done its work. The story was the requirement for cash and the venues that demanded it. This is why the same patterns keep repeating across decades in different assets with different headlines, but with the same underlying structure. So when you hear, "This move confirms it," the system is cornered. Understand the move as a concrete change. Gold margin from 6% to 8%, silver margin from 11% to 15%, with heightened risk brackets even higher. 81. All while an index like the FTSE 100 closes around 10,641. That combination is not random. It's a stress test unfolding in public. This is signal and structure, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And the question isn't whether markets swing again. The question is whether the next time the system demands collateral, you'll recognize the sound of the corner before the crowd does right now.